Well, hey there, everyone. Happy Friday, September 26, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of beautiful early fall day here in Redmond, Washington. Hope you guys are all doing well, thriving, staying safe, being well wherever you're at. And thanks so much for joining me here on the show. Our goal with Chart This, with our daily market recap show, is to entertain a little bit, to inform, to educate, right? To help you understand what's happening in the world around you, to focus on movements, focus on the character of the markets and where we're seeing changes, right? What's working and what's not, and then focusing on the benefits of technical analysis to help us make better decisions and minimize the negative impact of our behavioral biases. It's a pleasure to do the show, and I thank you so much for the great questions you guys ask day in, day out as we do our live stream. And so today, as we do often on Fridays, I'd love to take some of the great questions we've received from all of you in the last week or so and spend a little more time answering them here on the show. As always, you're welcome to ask questions if you're watching the show later on our YouTube channel. No worries. Use the comment section on our YouTube channel to drop any questions. We'll review them often, and I actually review every one of them, and we'll include some of them, as many as we can, here on the show. Just a quick check on what the markets are doing here. Friday, we're recording this a little earlier in the day, just before the close, but it looks like it's going to be a pretty decent day for the major averages, the S&P, the NASDAQ, the Dow, as of sort of, 30 minutes before the close, looking pretty good. And you can see volatility's coming down a bit. All 11 of the S&P sectors at this point are up, driven by consumer discretionary and utilities. And as we look elsewhere, we can see that commodities are doing pretty well. Not as much the energy, but more the precious metals with gold and silver. The dollar slightly lower. Bond yields generally drifting higher, but not a huge movement day in the fixed income markets. Kind of a choppy day, but not a big one directionally. We're going to recap the markets in a lot more detail for our Market Misbehavior Premium members. As always, if you want to learn more about some of the tools and techniques we use on the show, and if you need help applying some of those in your own work, I kind of think of my goal of educating investors as kind of two levels. The one is what you're seeing here, just kind of keeping you updated and sharing some tips and tricks along the way. But I have what's called a premium membership, where I have virtual courses and a community where you can ask questions anytime, and some reports just for my members that I put out once a week and also once a month. So if you want more info, go to marketmisbehavior.com/premium. You can find all the information you need. Use the code YouTube when you check out for a special deal on your first 12 months on any plan. All right, with that in mind, let's get to some of the thoughtful questions you guys have all shared here in the last week or so. And I appreciate, as always, all the awesome questions you guys share. Here we go. Alibaba is breaking out to a new 2025 high, but RSI is still below the peak back in February. Is this a bearish divergence, or am I looking too far back? By the way, Spurs are doing well. And thank you for a shout out to one of my two soccer clubs that I'm passionate about, Tottenham Hotspur. I also am a supporter of the Seattle Sounders here in the Seattle area, looking to make it into the MLS playoffs and hopefully making an awesome run. Tottenham is a club I followed for years after a player from my high school outside of Cleveland ended up being a goalie for Tottenham back in the day, and I just kept following them. Heung-min Son, who was a striker forward at Tottenham, actually switched to sports club or LA Football Club, and unfortunately, big rival with the Seattle Sounders. So I get to watch Son play, but now it's for the other teams. That's rough, I would say. All right, to your question, let's look at the chart of Alibaba. So what does it mean? Let's look at a lot of the Chinese names listed in the U.S. Alibaba comes to mind. Baidu is another one that one of my premium members was asking about. I was just chatting with him earlier today about that. These obviously had pretty good moves to the upside, and a lot of those have gapped pretty aggressively. You're particularly asking about the RSI and comparing the RSI, what we see here in September of 2025, to the RSI that we saw back in February. And is that a divergence? So I would say no, right? On a daily time frame, you're looking more for like this kind of thing, right? A bearish momentum divergence on a daily chart, I would think of it as sort of like in the 3 to 6 week range or so, maybe 2 to 6, 2 to 5 weeks, somewhere in there. Anything longer than that, and I think you're probably better off looking at like a weekly chart, because that's going to understand the divergences, or at least, recognize the relationship between price action and momentum. What we're looking for is when there's a change of character, right? When the market's moving higher on weaker momentum. So what's interesting is on this chart of Alibaba, you have a really clear bearish divergence back here at the February peak, right? And it's actually peaked out in March. The S&P and the NASDAQ peaked in February. Alibaba actually made a new high in March before bouncing down to hit the 200-day moving average. So that divergence of higher highs in price, lower peaks in momentum, that's kind of the divergence on a daily time frame. That's sort of the classic measure. If you're trying to compare this high to this high over here and this momentum to this momentum, I would say you're much better off looking at like a weekly chart, which is really going to understand more about the relationship on that sort of time frame, a larger time frame. Even that, I don't think you see any sort of divergence that makes sense here. The weekly RSI is actually almost at the same level, if not slightly higher than what we saw at the February peak. So weekly data is suggesting, pretty strong here. Now, if you look at the daily and the weekly charts, here's the problem with Alibaba, and I would argue here's a problem with the S&P 500 as well. And I just, on my Market Misbehavior podcast, had an interview with Frank Capillari this week of Cap Thesis. Frank's awesome. I've followed Frank's work for many, many years. And, he highlighted the fact that the S&P 500 was recently overbought on the daily and weekly charts. You can see with the chart of Alibaba on the weekly chart, overbought in September of 2024, overbought in February of 2025, overbought again here in September of 2025. So is that a good thing or a bad thing? Well, if you look back, it's often been sort of a negative thing, at least in the short term, because when we're overbought on both timeframes like that, that just basically means the market's risen to such a point that you often just have a normal kind of natural pullback that would occur. It doesn't mean that the longer term uptrend can't be in great shape. It doesn't mean we can't eventually make new all-time highs. You can see just even on this chart, other times where we become overbought and, we end up being higher 6 months later, but it doesn't mean there's a straight line between the current high and the high 6 months down the road. It might be a little bit of pain here. So the setup that I'm seeing here going into the fourth quarter is unusually strong price action, unusually strong momentum, which suggests some sort of pullback. And maybe this week we're seeing some of the signs of that with some of the rotation that we've seen and some of the pullback that we've seen in the major averages. So short answer, yeah, no, I wouldn't be comparing these 2 points on a daily chart. I'd be looking like 2 to 5 weeks as sort of a general rule of thumb amount of time for a divergence. Next question. Do you typically invest and trade in ETFs only? What would be some ETFs to keep in the watch list in the current market condition and in general for long as well as short term? That's a lot of question packed into 2 questions there. So I'll answer a bit of it. So do I typically trade and invest in ETFs? Yeah, my own portfolios, I kind of have, I do what's called the core and explore model. I have a core position, which uses all ETFs. I have an exploratory position where I use a mix of stocks and ETFs. The core position is more systematic. It's based on a momentum model that I've adapted from a number of things that I've used over the years. But that explore position, right, the position that I'm managing more actively is really driven by where I'm seeing opportunities and using the technical analysis tools that I share with you on all the content that I put out there. And there are some individual stocks, although to be honest with you, I don't do a ton with individual stocks, relatively speaking. I usually use more ETFs. But I use a mix, I would say, in that active portion that I manage. What would be some ETFs to watch? So if you watch my podcast, I ask a version of that question to every guest. I phrase it in different ways depending on how the conversation has gone, but it's usually along the way of, where do you see opportunities? If what you just said is true, what would give investors a great opportunity to play that theme? I just try to get to some specific stocks or ETFs that would follow in their expectations going forward, just to get ideas about where other investors are seeing opportunities. And I would say, based on a lot of those recent conversations and based on my own analysis of tons of charts, here are the kind of things that I find myself going to. I mean, one would be traditional energy names, and this is one that I've probably fought more than anything. because crude oil prices have remained fairly low. This is the XOP, which is an oil and gas exploration and production ETF. And as always, the standard disclaimers I put on all my content is not a recommendation. I'm just sharing charts that I think are particularly compelling given their recent price action. And I would say, oil and gas, kind of traditional, what we call old energy stocks, are really starting to break out. It's not all of them, but you can see the chart of the XOP making a new 3-month high as we go into the weekend. The traditional energy sector has, arguably not been as strong as I would expect, given the current administration, given the fact that the Biden administration here in the U.S. was very green energy, clean energy focused, and really, leaning away from traditional energy sources. The new administration, the Trump administration, you would think way more, supportive of traditional energy companies, but the charts just have not been particularly good. The sector's been one of the worst performers, but I think that's starting to change here as we wrap the third quarter. So, kind of old energy would be one bucket. New energy, there's a whole bunch of things that have come up in recent conversations. I would say charts that are strong and that represent these themes. Clean energy stocks is looking at like solar, wind. This is an iShares ETF, ICLN. Rare earth metals have actually come up with a number of my recent guests. I actually interviewed Mary Ellen McGonigal, and that's actually not released yet. Hopefully, later today, maybe this weekend, we'll get that episode out. But this is a VanEck Rare Earth and Strategic Metals ETF. This is a plan like lithium that's used for a lot of batteries for electric vehicles. NLR is one ETF that I own in my own accounts in terms of disclosure. This is a uranium and nuclear ETF. So it's sort of like old energy and new energy all seems to be doing quite well. And I think the story there is all this cool technology that we're all excited about, and the stocks that have had incredible runs, they all require an immense amount of power to power their stuff, right? Whether it's generative AI or mining for cryptocurrencies, just the power needs of this technology is immense. And so, looking at different energy sources, old energy, fossil fuels, new energy, wind, solar, nuclear, I think that's all part of that theme. I mean, the third bucket then would be the technology play. And I have plenty of exposure to big tech through different ETFs. I don't hold SMH directly, but this is an example of the type of ETF that I think has been quite strong here. I mean, you could argue that these ETFs and stocks are very overvalued, but they're still going up. And so I'm a fan of following trends as long as they persist, as I shared in a webcast earlier this week. And the last one I would say would be gold, precious metals, gold, silver. GLD is an ETF that I own. You can look at gold stocks through things like the GDX. Those are examples of the types of ETFs that I currently own or bets that I'm making in my portfolio to sort of answer your question. I would generally describe these as sort of medium-term plays, right? I mean, long-term play. I think some of these are long-term, right? Things like gold, and I would say like clean energy. I mean, I think those are themes that work for quite some time, but they're showing particular strength recently, which is why I'm so interested. I actually run a regular scan for ETFs in a list that I've created, making new 3-month highs, and that's where I often find opportunities with ETFs that are just starting to emerge. So I would encourage you to run your own scans to find ETFs that fit your criteria. And again, the podcast that I run, called the Market Misbehavior Podcast, I ask a version of that question on every episode, basically. So listen to what other smart people say, and hopefully you get some good ideas. Next question. John Murphy wrote that leadership by energy typically takes place near the end of an economic expansion. Would you say energy leadership is a similar warning sign compared to consumer staples? And you asked a lot more in that question. I had to boil it down just to fit it all on the screen here. But you asked me, does it make sense to go after charts in those sectors when they're doing well? And if you listen to how I wrap every episode of this show, I say it's always a good time to own good charts, and I truly believe that. I think investors get into trouble when they think about what should work or what might work, as opposed to just paying attention to what is working, right? If you think gold's not a good bet in a bull market for stocks, you missed just one of the best trades in 2025. It's the fact that just gold's been on a tear, and I've owned gold because the charts look good. And it doesn't matter. The market doesn't care what I think gold should do. It's doing what it's doing. And I want to just make sure that I follow those trends as much as possible. So I would say, yeah, if the charts look good in energy, if the charts look good in consumer staples, I'm going to rotate to those winning charts. And John Murphy book, by the way, I'm guessing you're thinking of Trading with Intermarket Analysis, or I guess a number of books. One's just called Intermarket Analysis, I want to say. Fantastic books. Highly recommend John Murphy's work. I read all of it as much as I could, and a huge fan. And yeah, to your particular question, though, there's a great page on stockcharts.com. It is free to access. I just need to figure out where it is. It says it's called like sector perf charts. Let's see where that might be. Sector perf chart. Here we go. So there's this kind of really not particularly attractive histogram, I guess we would call it, of these different sector performance. But below here, this is what I want you to look at. Sam Stovall is currently the strategist at CFRA Research, based in the New York area, and he is a fantastic strategist, and really literally wrote the book on sector rotation that so many of us kind of take for granted. And this visualization that you see here is kind of an idealized illustration of Sam Stovall's work, talking about the relationship between the stock market and the economy. So this is the market cycle in orange, and this is the economic cycle in blue. So remember that the stock market is a leading indicator for the economy, and not the reverse. So a lot of people follow economic indicators thinking that's a leading indicator for stocks. You're completely flipping that relationship. The stock market is one of the best leading indicators for the economy, right? The market will turn before economic indicators reflect strength or weakness. That's something I often find people get into trouble with. Having said that, if you look above there, this kind of highlights which sectors tend to thrive at different points in the cycle, right? So if you look toward the end of a bull market cycle, look at what tends to do really, really well: materials and energy. Now, not all materials are doing pretty good, but steel companies aren't bad. And certainly gold and precious metals are remarkably strong. Those are both in the materials sector. And energy, as I've highlighted, is starting to look pretty good. Now, the thing is, some of these other things like technology are actually still quite strong, and communication services and others are strong as well. But the fact that we're seeing like materials and energy start to do so well does start to imply we're probably in the later stages of a bull market phase. If you look right after that, when the market starts to turn, that's when investors start to get really defensive. So these are considered cyclical, companies. So when the economy is growing, these are companies that do well, right? So even though the market's kind of getting near a top, the economic data usually starts to improve, and that's what allows these economically sensitive companies to do very, very well. But as the market starts to rotate lower, while the economic data is often still pretty good, you see a rotation to more defensive sectors. That's why looking at the relative performance of consumer staples, of utilities, of real estate has become a really important part of my process, because I found so often when I see rotations there, that often implies we're kind of toward the end. So yeah, I would say John wrote about that. Sam Stovall, other people that are smart have written about that as well. The improvement in energy that we're seeing now, it's not great when you think about what that might mean for the overall market conditions here. We got a couple more questions to get to here in a moment. I do want to thank a longtime supporter of the channel, great strategic partner, Seeking Alpha. So you can go to marketmisbehavior.com/Seeking Alpha to learn more about their platform. And also, if you use my link, it'll give you a little better deal on a premium membership, which I have access to and have enjoyed quite a bit. They have great capabilities to import a list of stocks and look at what they call the portfolio health, look at dividend payments and potential cash payouts over your entire portfolio, so you can really think as an income investor what that might be. They have great kind of health check, kind of like taking your portfolio to the doctor and seeing what's good. It's like taking it for a wellness visit and seeing where there might be opportunities for struggling. They have a quantitative model that they designed in-house that I think is it's an institutional quality quantitative model that individual investors have access to. So I'd encourage you to check it out. Go to marketmisbehavior.com/Seeking Alpha, where you can scan the QR code that you see on your screen. If you use my link, gives you a little better deal than if you went there separately, and helps me make Market Misbehavior awesome. So thanks again to Seeking Alpha. All right, next questions. Dave, do you use arithmetic charts or logarithmic charts, and why? I get a version of this question randomly, right? And kind of off and on. And part of the reason is because I use log scale charts exclusively. Let me give a good example. So log scale charts, I would argue 99% of the time are the way you should go. There are very few reasons why using arithmetic charts makes a lot of sense, and I will explain why. And I will tell you, I'm very biased on this opinion because I spent a lot of years working for long-term investors, where the percent improvement in your portfolio is the most important thing you want to track, right? You're trying to track not just dollar moves. Are you up $1 or down 50 cents? You're looking at the percentage moves in this basket of stocks, and you're looking at the percentage moves in a benchmark. And so working with a lot of institutional investors running larger funds, that was really the way that you thought of it. And so log scale charts, basically the vertical axis is defined by equal treatment of percentage terms. An arithmetic scale chart, which you can see here, $1 is the same height, right? Whether it's 165 to 170 or 275 to 285 points has the same vertical treatment. But if you do a log scale chart, you can see that the higher you get, the chart gets a little more compressed, because those are, dollar amounts are smaller percentage swings when you get in higher values. It doesn't make a ton of difference on a lot of daily charts, but if you're looking at like a weekly chart of Apple, you can see how the log scale chart really shows the percentage gains. So a slope on the log scale chart is a consistent percentage return. So I can tell when the pace of the advance is slowing or increasing. If we go to arithmetic scale, most charts in the US will kind of have this hockey stick kind of look, particularly if they've been going up a lot, because the most recent price action is going to be pretty exaggerated. And then back here, it looks like it was a very low volatility stock. That's just because we're trading at a higher dollar value. So the short answer is log scale charts, I would argue, make sense. If you're drawing trend lines, you should be using log scale charts, because that's what those lines should represent, is a change in the pace of the trend. The only time it really doesn't matter, if you're looking at like an intraday chart, it doesn't matter, just because the moves aren't going to be enough to really change visually what's happening. So I would say in that case, it doesn't really make a ton. But if you're looking at any meaningful amount of time on any stock or ETF, or I would argue any other asset class, log scale charts make sense, and that's why I use them. Quick story on that: the chairman of Fidelity, who passed away years ago, unfortunately, Ned Johnson. I had a chance to work directly with him for a number of years when he was the chairman, and we would have thousands of charts displayed in a big chart room, a big room full of all of these charts. And he would be able to pick out any of them. If we ever made the mistake of putting one up that was not a log scale chart, we would get called out and I would get in trouble. So we got used to not putting those up there. Next question. Even investors get vacations. Do you set high or low open trade triggers while you're on vacation on some of your positions? So great story on this one. In my back in the day, I used to manage a team of technical analysts working with professional money managers. And one of my analysts was having a tough performance stretch. And he, was doing pretty well, but just not as good as you wanted him to do, right? He just was not getting a good feel for the sectors he was covering. He went on vacation for 3 weeks. He came back, and that 3-week period ended up being like his best performance period during that review cycle, right? Twice a year, we would review everyone's performance. And that 3-week period, all of a sudden his performance was very, very good. And so we're like, all right, the answer is just get out, go take more vacations, and this is going to be better for all of us. But what we realized was that he was just trading way too actively. He was turning over things way too much. And so as a result, he was kind of not really getting the benefit of just making bets and just being patient about them. And so just taking a vacation, he obviously traded a lot less. And as a result, he just let things happen and wasn't shaken out of things way too much, turns out. And so it was a great learning opportunity and allowed us to work together to think about how he could limit his turnover, meaning how much he was just churning through positions and just not being so aggressive about trying to trade out of a period of bad performance. It's just kind of, making bets and then seeing what happened. So there's a story on the benefits of taking vacations. And I would argue I'm a huge fan of taking vacations just to shake it up. I get, as much as I talk about how routines are important, I get really jittery if I get stuck, if I feel like I'm complacent and stuck in a set of routines. I have to shake it up, which means get out of the way, work from different locations, take vacations, take my family somewhere, get on a plane, and just kind of mentally shift, talk to other people, just get out of your routines. And then when you come back, you're sort of motivated to do a lot of awesome things, I hope. So the short answer, to answer your question directly, do I set trade triggers? So I'm not big on automated trades. I'm not a big fan of placing trades and then leaving and then just hoping that's all executed right. I am a fan of setting alerts, right? So my version of, and again, that's more of a, I think that's more of a preference thing. For me, I've never been a huge fan of just outsourcing everything to a trader. Maybe that's just because I've seen too many issues, probably that don't happen as often as I think, where people, something's, executed incorrectly, or it's not where you thought it was, and all of a sudden something bad happens. I just don't like, my account being manipulated by even my own ideas when I'm not looking at it. So I tend to use alerts, right? Instead of automating a trade, automating a stop, I set price alerts. And when my price alert is triggered, that tells me to revisit the position. So when I'm away, I make sure that I set alerts on any positions that I'm either concerned about or that I just want to make sure I don't get into trouble. I will set price alerts, and I do stock charts mostly for that, although some on Fidelity, which is a platform that I use for a lot of trading. And I make sure it goes to my phone and goes to my email. So wherever I'm at these days, you can get alerts for the most part, and do that. The other thing is I often will just go kind of risk off. Like I won't make any short-term bets. I'll just make sure the bets that I'm making, it's okay if I'm gone for 2 weeks. I shouldn't be that worried about it. A lot of times I find, particularly people that are more long-term investors, you pay too much attention to the short term and feel like if you're not watching the market every day, something bad might happen. Like the whole benefit of being a long-term investor is you should be able to go away for a couple of days and not have to worry about what's happening in your account. Now, if you're more short-term oriented, I totally get it. Like that's so in my opinion, that means you take a risk off, you go to more neutral positioning, go more to benchmark kind of position, just like sit in the S&P kind of thing until you come back and you want to manage more actively. That's how I would tend to think about it. But I do set alerts when I'm away, and that's what kind of keeps me plugged into key things. Final question regarding Dow theory: would not Amazon need to be put into the whole shipping equation? Their vertical integration surely must have an impact on that sector. Yeah, thanks for the question. So I actually did a video, I think it was the end of last week, on Dow theory. And hold on, I need to find the right chart. I think it's in here. Yeah, this is the chart we talked about. So Dow theory, and again, I'd encourage you to check out the video. I'll try to remember to put in a link to the, let me write this down. Put a link to the Dow theory video that I'm referring to right at the moment. The Dow Industrials are in the top panel. The bottom panel is the Dow Transports. This is a concept created by Charles Dow, 120 plus years ago, where he talked about the Dow Industrials and the Dow Railroads. And back at the time Charles Dow was writing this, obviously this was a very different world for the equity markets, but he was basically talking about the industrials as the producers of goods and the railroads as the distributors of goods. Because you had a bunch of, it was an industrial economy. You have a bunch of industrial companies making stuff, and then a bunch of, railroad companies that would take the stuff and get it out to consumers. So it was the producers of goods and the distributors of goods, and seeing how they were doing. Nowadays, that relationship is completely different. So what we talked about is in the Dow, using the indexes that are the evolution of the indexes Charles Dow was using. The Dow Industrials are still there, although the Dow Industrials has a bunch of stuff that aren't really kind of industrial companies, right? Like Goldman Sachs is in the Dow. That they don't make stuff really. They, it's a bunch of fake numbers on computers as far as we're concerned, right? And there's no physical goods really. The transports, right? It's not, a bunch of railroad companies. It is like FedEx and UPS kind of companies, but it's also airlines that have a lot of, flying a lot of passengers around. So other things as well, trucking companies as well, of course. So, it's not a perfect representation of what's happening in a service economy. And that's why we use adapted versions of that. I have what's called a newer Dow theory, where I use an equal weighted S&P and an equal weighted NASDAQ, sort of looking at the old economy versus the new economy, and thinking more about the relationship between kind of the pillars of a service oriented economy. For me, that's been a decent adaptation and has served me pretty well, recognizing when these indexes are not in agreement. But the problem, I mean, another problem besides the fact that just these indexes have changed, just what's not in there. Like Amazon isn't included in this. And Amazon is arguably one of the biggest producers of it, but they actually are kind of everything, right? They're not necessarily producing stuff, although they kind of are, but they're definitely a big distributor, right? And so that's another reason why just looking at the Dow Industrials and the Dow Transports, it's tough to make that mean what it did when Charles Dow was using it. And I didn't mention Amazon particularly in that video, but I think that's part of the challenges of this traditional style of analysis. So for me, what I more often refer to is what I call the newer Dow theory, which looks at the equal weighted S&P 500 and the equal weighted NASDAQ. For me, that's been a pretty good adaptation. This is a really good book, by the way, and I'll try to remember to put a link to this book as well, called Dow Theory for the 21st Century. And the name of the author escapes me. It's like Shanup or something like that. But I'll find the book and put a link to that as well. If you want to read more about sort of a modern version, a modern take on Charles Dow's work, there's some good books to make sense of that. All right, folks, that'll do it. Listen, those are all questions that came from people like you watching the show here in the last week and just taking a moment to throw questions my way. I can't tell you how much I appreciate all the thoughtful questions you guys share on our live stream. And also when we do, the videos on our YouTube channel. You're always welcome to share questions with me. I appreciate them very much. And I hope you enjoy these mailbag episodes where we can dig a little bit into some of the themes that are top of mind for you. So keep the great questions coming. Have a fantastic weekend. Go Buckeyes, beat the Washington Huskies. I wish you all a fantastic weekend. And remember, it's always a good time to own good charts. We'll see you next week.